Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. The RBI's State of Economy report says that the inflation might have hit the peak and could start to lose steam from here. But the same report cautions that the fight against inflation will be dogged and prolonged. The opinion on the future course of rate action has also put the experts in warning camps. Some believe that the RBI should breathe easy, while others are advising against it. So, amid the divided house, we try to find if the worst of inflation is behind us.
India's consumer price index-based inflation for the month of September surged to a 5-month high of 7.4%. This inflation print officially marks, for the first time, the failure of the RBI MPC to keep inflation within the mandated target range. Since May this year, the central bank has raised the repo rate by 190 basis points to rein in persistently high inflation. The repo rate is currently at 5.9%. However, the latest inflation data will likely warrant more rate hikes and a shift away from surplus liquidity conditions in the banking system. The picture on growth is also not rosy. In September, the RBI reduced its FY23 GDP growth forecast to 7% from 7.2%. A number of global institutions, including the IMF and the World Bank, have also lowered the country's growth forecasts. Since higher interest rates depress aggregate demand in the economy, the extent to which the RBI is willing to go to tame inflation could either support growth or prove to be an impediment. Against this backdrop, two external members of the MPC have expressed concerns about fragile growth, calling for slower rate hikes. Stating that monetary policy acts with a lag, Professor Jayant R. Verma has called for pausing at a repo rate of 6%. In the recently released minutes of the September MPC meeting, Verma said that it was dangerous to push the policy well above the neutral rate in an environment where the growth outlook was very fragile, and called for a pause after the September hike. Verma said that India had seen unacceptably low levels of growth for longer than it had seen unacceptable levels of inflation, adding that going beyond 6% would compromise the second part of the MPC's mandate to support growth. Verma voted against the resolution to remain focused on withdrawal of accommodation to keep inflation within target.
I believe that in another quarter or two, it will drop below the 6%. So in a couple of quarters, we should be in the ballpark range of 5. That is absolutely essential. You bring inflation down by pushing growth down. The MPC has to balance these two mandates, inflation and growth, and ask how much pain do we want to inflict on the economy versus how quickly do we want to bring it down to 4%.
There are reasons to be sanguine on the inflation front.
Based on the current trends, I would like to assume that the worst is behind us. So if you look at the inflation drivers, it is largely the global commodity prices. So if you look at the last 2 months, some of the commodity price inflation is in a negative zone. So to that extent, I would say that inflation in India is behind us. In fact, I was on record to say that it has actually peaked in the month of May 2022 when it reached 7.8%, and we should be stabilizing at 6% soon.
The other MPC member, Ashima Goyal, said that high repo rates imposed heavy costs on India in 2011, 2014 and 2018, leading to a credit and investment slowdown. She added that it was necessary to proceed very carefully now that forward-looking real interest rates were positive. Goyal was the only member who voted against a 50 basis point repo rate hike during the September policy. Instead, she had pitched for a 35 basis point hike. She told Business Standard recently that India's real interest rate should not exceed 1%. Going by the MPC's inflation projections, this would imply little room for further rate hikes in the current tightening cycle. On how the MPC could minimize the impact on growth while still achieving its inflation target, Goyal said,
I think Indian monetary policy was too much in stimulus just after the global financial crisis, and then there were double deficits and various fragility. So it became too tight. There was overreaction. And this is what we are seeing the Fed do now. There was too much stimulus after COVID-19 and overreaction now. And we are seeing a lot of problems in financial markets abroad. Yeah. So I think moderation is a lesson that perhaps Indian policy, monetary and other policies have learned to be counter-cyclical, not to let the real rates become too negative or too positive. And as long as we have the policy space to do these kind of adjustments, and as long as we do that, I think we will be able to bring down inflation. Also with monetary fiscal coordination, because there is a lot of fiscal action possible on the supply side. For example, the government targeted free food provision is one reason why wages have not risen. And in the 2010s, we had second round inflation because the rural real wages were rising in double digits almost. Today they are flat, right? So we don't have those kind of pressures today. And we have the policy space to both moderate inflation without hurting growth too much.
However, there are two sides to this debate. The MPC minutes show that RBI Deputy Governor Michael Patra has said that monetary policy must shift to red alert because not only are inflation expectations rising, there are indications that they are becoming unanchored over a 1 year ahead horizon. According to Patra, inflation has become unyielding and tightly range-bound around the upper tolerance band of the inflation target. The IMF expects average retail price inflation in India at 6.9% for 2022-23. IMF's India Mission Chief Nada Choueri too believes that inflation will not come below RBI's tolerance level in FY23. She said that the IMF projects significant momentum in prices and doesn't see inflation falling below 6% in FY23. However, she added that the agency expects it to fall below 6% in FY24. It is clear that during the September policy, sharp differences in opinion emerged among MPC members, with some asking for restraint on future rate hikes, while others continued to call for aggressive action. This will make the next review of the Monetary Policy Committee, scheduled in the first week of December, an interesting event. Overall, given the large number of uncertainties on the global stage, it's likely that more challenges on both the inflation and growth front could emerge.
Most wait for festival season to loosen the purse strings, and no one knows it better than the corporate world. Online sellers start offering heavy discounts and make the most of the season. One of them, e-commerce unicorn Meesho, clocked a 68% jump in sales during a 5-day festival season sale. Business Standard Surajit Dasgupta caught up with Utkrishta Kumar, Meesho's business CXO, to know more about the record sales and also about the company's future plans. Let's listen in to the interview.
Congratulations for the big sale that you had and all the records that you have sort of broken with it. Just wanted to understand how it was and what is the kind of depth that you could get in terms of markets, in terms of towns, cities.
First of all, thank you for having me here, Sujit. Of course, as you rightly pointed out, it was one of the biggest events that we had, which we called Meesho Mega Blockbuster Sale, that ran from 23rd of September to 27th of September. And during those 5 days, we did a total of 3.34 crore orders. And just in terms of magnitude, this was 68% up from previous sale. Just our day one, that number was 87.6 lakh orders, which was an 80% year-on-year increase. What was also very interesting that around 80% of our orders came from tier 2, but this sale, even 60% of them came from tier 4 plus cities. So again, just went on to showcase how our value proposition of affordability has continued to play a very strong role, and how we have emerged as a preferred destination for Bharat. And again, this event was a very strong validation of our overarching mission, which is to democratize internet commerce for everyone.
How many towns and cities, what's the kind of penetration that you had, and how has this helped in testing out the pay, because you are talking about even tier 4 cities where you've been able.
It is important to understand that this kind of penetration in tier 4 in India is unprecedented. In fact, a lot of these smaller villages or these remote areas, they are very new to e-commerce to begin with, right? And this sale event was again one of the ways to go ahead and ensure that these new to e-commerce transactors are getting the selection they want at the pricing which is affordable to them during this event. In terms of which could be some of those cities again or towns, they are all our presence was felt throughout, from the remote places in north, unknown towns which you could have here in Himachal, a city like Una, or Chimakutti in Andhra Pradesh, Kalimpong in West Bengal, Bharuch in Gujarat, Leh, Ladakh, a lot of northeast locations. We've gotten orders from everywhere.
What is the kind of average ASPs have you seen in these, these 60% compared to the average ASPs that you have? I mean, what is the behavioral thing which you have learned from this whole experience?
Yeah, so behaviorally, I think there is a category nuance here, right? So typically, we tend to associate the mega sale events in the ecosystem as sale events that cater to certain categories or specific SKUs. We as a platform are very democratic in nature. We as a platform have all categories that a user wants, right? So and hence our growth has also been very democratic, right? So while fashion has been the core mainstay for Meesho, what we have seen this year that there has been a non-linear jump in categories like home and kitchen, electronic accessories, beauty and personal care. So everything has outperformed expectations very well, and hence comparing ASPs across categories might not do justice to the conclusions we want to draw from it. What we have witnessed for sure is that the kind of discounts that our sellers were providing to our users, we've managed to bring down the pricing in some of these categories for it to become a lot more enticing for our users to convert. But one number here will not do justice.
How does the model work? You organize, it's a platform where sellers come in. So what is the sort of monetization model that you have now?
Right. So to begin with, we are a 0% commission structure, right? So any seller in India can start selling on Meesho who wants to sell online. The entire process is pretty smooth, very frictionless. And this again is accentuated by the fact that, the assortment we have, it's unmatched. The number of sellers or the number of catalogs or products listings that we have on platform is pretty massive. And when it comes to the monetization potential, we have different streams. While seller ads continue to be one of the major ways we look at monetization, there are other instruments too, which are contributing in getting us closer to our profitability goal.
Distribution of it last mile, who does? You do or others do?
So we don't own assets. We are a very tech-heavy setup, and we ensure that we work very closely with all the major 3PLs or even smaller 3PLs that the ecosystem has, and we leverage their capabilities and their infra to deliver these orders to the last mile.
Your next sort of investment in growth would require what? I mean, more investment in which areas, basically? So where will the growth, the requirement of investment be?
Yeah, so what I want to reiterate here, that the opportunity that we are sitting on is pretty huge. As I pointed out earlier, that around 600 odd million people have a smartphone, are online, and there is a massive opportunity to get these users to come and shop online, right? So we'll continue to make rapid strides on the same front. Our biggest investment will continue to be towards technology, to ensure that we are investing the most in technology and product, and ensuring that we deliver the experience that the underserved consumer today wants. And we have a huge roadmap, and we genuinely think that we are just at the tip of the iceberg, and the opportunity that stays ahead of us is pretty massive.
Okay. Thanks a lot.
The jewelry sector too is gearing up for Dhanteras and Diwali. It is expecting to benefit from pent-up demand as festive fervor kicks in. So, is it time to add stocks of jewelry retailers to your portfolio? Well, we find out in our next report.
Expectations of strong sales this festive season have led to a sharp run-up in shares of jewelry retailers in the past few months. For instance, shares of Kalyan Jewellers and PC Jeweler have rallied up to 380% so far in fiscal 2023, while Titan is up 3% as compared to a fractional decline in the BSE Sensex during this period. Going by past trends, jewelers could see bumper sales this Dhanteras, riding on high pent-up demand after a COVID-19 lull and softening in gold prices. As per HDFC Securities, the first 10 festive days have already clocked 20% jewelry sales volume growth. Analysts remain fairly upbeat on jewelry stocks as they expect this trend to continue going forward.
So currently we are in peak season from now till February. Because of marriage season, festival season, there's a lot of buying can happen in jewelry, and because of the pent-up demand during COVID, a lot of people are now getting married and they are spending money on jewelry. This is causing some above normal push to the demand. So net, the current outlook is positive. One will have to check as to whether valuations have already run up, or there is still some scope. That we'll have to always keep in mind. We'll have to be aware of whether we are overpaying at some point or not.
The upbeat outlook has also been backed by the industry in their recent pre-quarterly updates. For the July-September quarter, Titan said it saw a healthy 18% yearly growth in its jewelry sales, while Kalyan Jewellers' overall sales grew 20% on positive consumer sentiment and increased store walk-ins. The latter added that it has seen significant benefits from the ongoing shift in demand towards branded retail outlets. This transition among shoppers from traditional small retailers to national chains is another key factor, making analysts positive on the space.
Yeah, after COVID, now people are coming out to buy. Jewelry cannot be bought online. So it has to be, direct, they have to wear, see, they have to like the design. And, the important shift which is happening is from unorganized to organized, So that is giving the organized player a very good thing. And I think it is a structural bull rally in jewelry sector as market share gain will be there for organized sector in a very big way. Whenever gold prices decline, they will have a negative impact because their inventory will be at a higher cost. So that will have an impact, but over a period of time, everything gets adjusted. If you are looking at every quarter, then it will have an impact. But year-on-year basis, these are manageable. At certain point, the gold will become stable or it will start to rally. That time things will start to work out for them.
Among stocks, IDBI Capital's Prabhakar remains bullish on Titan and Kalyan Jewellers from a long-term perspective, though he does not expect the sector to mirror the recent rally in the short term, as the street has already factored in festive season gains. Today, foreign flows and global cues will guide the markets. Besides, the Q2 earnings of three nifty companies, IndusInd Bank, Nestle and Ultratech Cement, will also be tracked.
A recent survey by Bank of America Corporation suggested market capitulation before a rally in stocks by the first half of next year. But what is market capitulation? Watch our next report to know more.
Capitulation in financial markets refers to a phenomenon where investors liquidate their positions during periods of extended decline in the stock price for fear of incurring a bigger loss. This panic selling may even emerge due to negative news flow, global sentiment, calamity, and margin calls, etc. Whenever a stock or index starts to fall with heavy volume, one can observe panic selling. In the chart, one can see the Nifty 50 benchmark index drop from 11,500 odd levels to near about 7,500 levels in a matter of just 13 trading sessions, owing to the COVID-19 induced lockdown in India. One needs to gauge the momentum through various candlestick patterns or formation for confirmation. Not all market weaknesses lead to panic selling or capitulation. One needs to be aware of the overall market sentiment and the trigger that causes the mayhem. The stock market is likely to see a bottom once the capitulation subsides. Squaring off one's position during capitulation gives traders a sense of relief. Technically, or even fundamentally, it is nearly impossible to predict the scope and time frame of a capitulation. The worst part of a market capitulation, other than the financial loss, is the impact it has on the investor mindset. This behavior is heavily influenced by various market news, FII inflow or outflow, fear of losing out, etc. There is also the tendency of investors to shift from one segment to another during such times. Investors may find equity highly risky at times and may thus shift to bonds, commodity, currency, etc. Over the years, investors have become highly cautious and now prefer to buy stocks a little higher, but only after the negative sentiment ebbs. More often than not, to lift the overall market mood, the regulator or the government brings in policies that restore sentiment.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Morgan Stanley recently said that emerging and Asian stocks are close to completing their current bear market cycle. That is all for today. For more news, views and analysis, please log on to business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.